Podcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the James Cooper Creston webinar on the Autumn Budget 2017. My name is Sharon Bedford and I'm a business tax partner at James Cooper Creston, and I'm here with my colleague Ian Miles, who heads up our private client tax team. Thank you for joining the webinar. I think it's generally acknowledged that the budget yesterday had to steer a steady ship. The economic forecast didn't give Philip Hammond much room for manoeuvre. Nevertheless, there were some changes, both for businesses and for individuals, that it's worth us talking through with you. And we're now going to do that. First of all, I will talk about the impact of the budget on businesses, and then Ian will join the webinar and he will talk about the impact of the budget on individuals and also cover VAT and duties. Starting then with corporation tax. There wasn't any changes announced yesterday to the rate of corporation tax. You might know that the current rate of corporation tax is 19%, and the plan is to reduce that to 17% from April 2020. However, those of us that work in the area always are looking for clues at what might happen. And actually, in that respect, Philip Hammond did make a useful statement, saying that he was committed to maintaining Britain's competitive corporation tax rates. This is welcome news. However, he also made another statement, which was probably a little bit more difficult to understand, which was basically saying that the reduction in corporation tax had actually generated an extra 20 billion pounds sterling for the Exchequer. I don't quite know where the £20 billion comes from, but it did prompt me to have a little look at the corporation tax rates and receipts over the last 10 years of published data, and that's shown on this graph. The blue bars show the corporation tax rate, and the orange squiggly line shows the corporation tax receipts. And the story from the graph is really quite interesting, because despite corporation tax rates falling, the actual receipts have gone up. And that's quite an interesting picture, and shows that actually maybe that the lower corporation tax rates are attracting more businesses to the UK. Staying with corporation tax then, a few more things just to mention. Firstly, capital allowances also remained unchanged, which means that there's still a 100% annual investment allowance of £200,000. That means that businesses can spend this amount of money on capital expenditure in any one accounting period and get a full write-off against their taxable profits. There was a change, however, to capital gains tax for companies. You may recall that if we go back a few years, both companies and individuals used to be able to uplift the cost of their assets that they were going to sell for an inflation index, which is known as the indexation allowance. That went quite a while ago for individuals, but it's still been there for companies. We learned yesterday that that indexation allowance is going to be frozen from the 1st of January 2018. So you'll effectively get an inflation index until that date, but not beyond that date. It's not a cliff edge, so there's no need to go out and sell all your assets on the 31st of December when you might prefer to be out partying. But nevertheless, that relief will disappear from that date. What's interesting on that, I think, is that's probably going to affect property owners more than any other companies. And this follows a trend that's been in tax policy over recent years that's tried to equal out the tax that's payable by individuals owning properties and individuals who own properties by companies. As we've now come to expect in the budget, there's also was a significant package of anti-avoidance measures announced yesterday, tweaking the legislation in lots of different ways, Interestingly, there were actually even tweaks to the Finance Act 2017, which only became law on the 16th of November. So we were already got changes to legislation that was barely a week old. Just before we leave corporation tax, another couple of points to note, sort of looking forward a little bit. Yesterday, the government issued a policy paper which was looking at the impact of the digital economy on the international corporation tax framework. You may recall that going back a few months, there was a lot in the press about the likes of Starbucks and Google and other such entities who were paying big royalties outside the UK, therefore reducing their UK profits, and those royalties were going off to low tax jurisdictions. Well, word of warning for any companies who are thinking of doing things along those lines, because the government are issuing a consultation which is going to be published on the 1st of December, which is going to look at how they can get UK withholding tax on royalties that are paid off to overseas low tax jurisdictions. There's also a general warning to people in that space that there will be more to follow. There's also going to be a consultation again in 2018, and as you'll appreciate as this webinar goes on, there's an awful lot of consultation that's on the cards currently into the intangible fixed asset regime to see whether that's actually fit for purpose for the 21st century and for UK companies who generate a lot of intellectual property. There's also quite a lot in the budget yesterday to encourage R&D, and I think this must be seen as a very positive message from the budget. The Chancellor actually announced that there'll be an additional 2.3 billion of spending on R&D by government up to 2022. Not full details are announced yet, but we're expecting a government white paper in the next few weeks with more details in that. There was also changes to R&D tax credits for large companies. R&D tax credits are really a success story of recent years, in that they give tax back and indeed tax incentives to companies to compensate them effectively for their expenditure on R&D. There's two schemes, one for large companies and one for smaller companies. No changes to the small SME scheme this time, but there were some tweaks to the large companies scheme. Firstly, there's going to be a pilot which will allow companies to get advanced clearance, get a little bit more assurance of whether their R&D projects will qualify in advance. But perhaps also more importantly, the rate of the R&D tax credit will increase from 11% to 12% from the 1st of January 2018. It is worth just a little note on that actually the R&D expenditure credit for the larger companies is actually a taxable credit. So if you look at the percentages after tax, the actual effective increase is from 8.9% to 9.7%. Nevertheless, a very welcome change. Staying with R&D and probably technology companies more widely, on the slide there is a soundbite from the Chancellor's speech yesterday. A new tech business is founded in Britain every hour, and I want that to be every half an hour. I guess what's recognised there is tech businesses are the future of the country, and indeed there were lots of measures to try and help the tech businesses. The main thrust of those was actually an action plan announced by the government to try and unlock over £20 billion of capital investment over the next 10 years. And on the slide there are listed some of the initiatives that are included in that action plan. I suppose reflecting on it, one of the sort of downsides of that is that the government money that's available isn't the full 20 billion by any means, and indeed what a lot of the action plan depends on is public-private initiatives. Nevertheless, it's very helpful and welcome, and time will tell how successful it is. There were actually, though, a few small tax changes to help in that action plan, one to the Enterprise Investment Scheme, or EIS, and one to Entrepreneurs Relief, and I'll now just have a quick look at those. Starting then with the Enterprise Investment Scheme, or EIS. Those of you that don't know, this is a very successful initiative that's been in place for many years now, which gives tax relief to individuals that invest in risk-based companies. Well, effectively, what those individuals can do is they can claim 30% of their investment back against their annual tax bill. There's a subset of EIS companies which are known as knowledge-intensive companies, which are really those companies that have significant R&D and are very much at the cutting edge of innovation. And there's been some relaxation in the rules for those knowledge-intensive companies wanting to take advantage of the EIS. Firstly, individuals investing in these companies, their annual allowance has gone up from 1 million to 2 million. If you look at the company side of things, currently the annual limit per company for EIS and together with other VCT type venture capital type investments has been at 5 million. That again is going to be doubled to 10 million. Although it's probably worth reflecting that the lifetime limit for such schemes appears to remain at 20 million. So perhaps not an overall increase, but what it will mean is that maybe the investment can get in sooner. There have been also a few tightenings of EIS, so that if there's tax motivated investments with limited risk of the capital being lost, then EIS may no longer be available from next year. Just briefly touching on Entrepreneurs Relief. Entrepreneurs Relief gives investors in companies that are also directors or employees of those companies a 10% tax rate on the sale of their shares, but one of the qualifying conditions is they have to hold at least 5% of the ordinary share capital in the full year prior to sale. We believe there's going to be a little bit of relaxation on that going forward when the investors get diluted below the 5%. The details are still sketchy, but it looks like, however, that there will be some sort of apportionment either by time or by value, so that they'll get Entrepreneurs Relief on part of their gain, but not all of it. A little bit on cars. Cars get benefit in kind. Company car tax and fuel benefit charges will go up again, increasing by RPI as expected. However, for those people who have diesel cars, diesel company cars that don't meet RDE2 standards, then the increase will go up even further. One small thing is on benefit in kinds for electric cars, and that was something that featured quite a lot in the budget yesterday, electric cars and driverless cars. There will be no benefit in kind for employees if they bring their own cars to work and are allowed to plug into their employees' electricity supply. One of the things that was said yesterday in the budget is that the Chancellor put an extra 3 billion aside from his pot to maybe cover the costs of Brexit. He acknowledged that really there was still not very much transparency on what might happen with Brexit, but nevertheless he wanted to set aside a contingency fund, and certainly the press this morning picking that up really thought that was particularly a good idea. And I guess what it did is it made us reflect a little bit on whether companies now should be doing any post-Brexit planning, and indeed I think prudent businesses should probably be having a little bit of a look. Certainly we're talking to our clients in that vein already. Of course, it's a little bit difficult when we don't know whether there's going to be a Brexit deal or no deal. And what this slide here does is sets out some of the options that are available and some of the ways that things might go. There are various options, but different ones of them involve different access to the single market, but but at the cost quite often of free movement for people. And I guess it's unknown at this moment whether that's something that the UK population will accept. The bottom bullet point on that slide, however, shows the fallback position, which is the World Trade Organization membership, which really gives no preferential access to the EU or any of the 53 markets with whom the EU have negotiated trade agreements. And I think really it's looking at that fallback position that it's useful for businesses to focus on a little bit now so that they can do some contingency planning. So just assuming for a few moments that worst case scenario does apply, it's probably worth looking at what businesses should be looking at. Certainly sensible to look at any tariffs that might arise on your business, for instance, food, technology, and these will vary from business to business. Some of the food tariffs are really quite high, but on the other hand, some of the technology tariffs are zero or very low, and therefore, there might be, that might not be an issue for some technology companies. Customs will need looking at. Certainly imports and exports to the EU may well take an awful lot longer if we don't get a deal than currently is the case. And it's probably necessary to look at your contracts and look at delivery timescales within them just to make sure that that's not going to be an issue. Currently within the EU, there's not really very many withholding taxes on things like dividends or royalties or other things. But if we leave the EU without a deal, it's likely that those special directives and agreements that relate to those will disappear, and we will have to fall back on our double tax agreements in the way we do with countries outside the EU currently. The issue we've got there, though, is that a lot of the EU double tax treaties haven't been updated for quite a long time, and therefore there are some issues in there. And indeed, it appears that only the double tax agreement with Finland actually reduces all withholding taxes to 0%. So companies, for instance, who have subsidiaries in countries such as Germany or Italy and receive dividends from those companies might find that they have real costs to their business tax that they can't recover, and that's something that needs to be looked at sooner rather than later. VAT also needs to be looked at. Currently, there's, for instance, as an example, there are special agreements, the MOS agreement, where e-services are provided to EU customers. It may be that if that's not available going forward, and one of the things that UK businesses might want to try and do is look whether they can or need to register for VAT elsewhere. And certainly corporation taxes themselves might actually change because a lot of the laws underwriting the corporation taxes are imposed to us by EU legislation, state aid barriers, etc., etc. And as those get removed, I think quite a lot of things will change. Just to wrap up then on the budget from a business perspective, there were a lot of initiatives announced yesterday. There was a little bit of relaxing in austerity in that there was some targeted spending on various areas, mostly to do with tech businesses and communications and house building. A lot of those are targeted in the Thames Valley and the Solent region, and therefore I think there are some real business opportunities available on the back of what was announced, both for clients and for the clients of contacts. And certainly it's worth following up on those as things evolve over the next few months. Anyway, I hope that's given you a quick canter through some of the initiatives yesterday for businesses, and now I'm going to pass over to Ian.
Good afternoon, ladies and gentlemen. I'm going to talk in the course of the next few minutes about some of the personal tax aspects from yesterday's Chancellor's budget, and also then go on and have a look at some of the duties and VAT aspects that we should take on board. Okay, so here are the income tax rates and allowances for the current year and for next year. The key point to take from this slide is that the government committed in the previous administration to trying to get to £50,000 of income before individuals started paying tax at higher rates. So for the current year, that's 1718, you can earn up to £45,000 and still be a basic rate taxpayer. That's going up from April next year to 46,350, which is a step in the right direction. And certainly the Chancellor was talking yesterday that £50,000 target is still in his sights. So just taking some of the things and implications of that previous slide, you will know that when your income goes over £100,000, you lose £1 of personal allowance for every £2 of income that you have. So whilst increasing the personal allowance is very good for those lower paid people, where you have somebody whose income is over £100,000, if in fact it's over 123,700 next year or 123,000 this year, you derive no benefit from the increased personal allowance, and all that happens is that you end up paying tax on £3 for every £2 that you earn, which means an effective rate of tax of about 60%. Otherwise, there were no changes to income tax at all. The 20, 40 and 45% rates remain. Dividend tax remains as it is, although the dividend allowance is cut to £2,000 from next year. There's no change to the additional rate tax threshold of 150,000, and the starting rate for savings tax of 0% on the first 5,000 remains, as does the savings allowance of £1,000 or £500, depending on whether you're a basic or higher rate taxpayer. So just turning our attention to capital gains tax, the annual exemption has gone up a little bit in line with inflation, but the rates have no changes. The one thing to note is that whereas from April 2015, non-residents have had to pay capital gains tax on disposals on gains where they've just sold a UK residential property, from April 19 they're going to have to pay capital gains tax on commercial property as well. So it will apply to all types of UK immovable property. Turning to inheritance tax and other things, nil rate band is still at 325,000 as expected. The residence nil rate band goes up by 25,000. ISAs, the limit is unchanged, of which 4,000 can still be into a lifetime ISA. But junior ISAs and child trust funds, the amount that can be put into those, has increased to £4,260, which is in line with CPI. No change to pensions. The cap is still 40,000, still tapered for incomes over 150,000 down to 10,000 gross by the time your income gets to 210,000. But the lifetime allowance has gone up by 3% in line with the CPI, so that it's now £1.03 million. Now, people who attended this webinar or came to one of our live ones last spring will have heard me talk about off-payroll working in the public sector. So this was all designed to catch people who'd been working in the public sector, had retired, and then went to sell their consultancy services back to the public sector, in essence doing exactly what they'd done before, but doing it through a company and accessing lower corporation tax rates than income tax rates. And I said at the time that I was surprised that the Chancellor had confined it to the public sector. Well, that slide is the same as last time, except for the last bullet point, where there is now going to be a consultation in 2018 to look at extending the scheme to the private sector. So private sector employees who've retired and then try and sell consultancy services back will also be caught. Okay, offshore avoidance. The Chancellor had a pop at the party sitting opposite him yesterday, saying, look, you've made a lot of noise about tackling tax avoidance, but actually it's our party that's done it, not you. And we're looking at here tightening up on remittances, payments from offshore trusts. So if income from an offshore trust is paid to someone who is a close family member of the UK resident settlor and it's paid offshore, then the person who set the trust up, who is in the UK, the UK resident settlor, is assessed to income tax. And on a different note, if a payment is made to an offshore individual from an offshore trust, who then makes an onward gift to a UK resident, then the recipient is treated as if they had received the distribution from the trust, whether that's income or capital, and taxed accordingly. Sharon also talked about the legislation that came in last week, which is already being amended. These are broadly amendments to that legislation. And that third small arrow point, capital payments, again, that is just something that couldn't be tweaked in the last set of rules that came in. The final point, which I think is new, is they're tightening the rules where taxpayers use the double taxation agreements between the UK and another country to either get better relief or to artificially create or increase tax relief, so to get a tax advantage. One bit of good news is on gift aid and donor benefits for charities. If you make a donation to a charity under gift aid, then it is quite possible to receive a relatively modest donation or benefit from the charity in return. So charities want to keep in touch with their donors. They can send brochures, literature, newsletters, and so on. And that's usually within the de minimis of the donor benefit rules. But they're complicated rules. And so the Chancellor said yesterday that he's going to replace the present complicated rules by 2 percentage thresholds. So for the first £100 of donation, it remains exactly the same. The benefit you can receive, the value of that benefit, can be up to 25% of the donation that you made. For larger donations, then there is an additional benefit that can be received, which can be up to 5% of the amount you've donated over £100. And the maximum benefit on an annual basis remains the same at £2,500. There are some consultations coming up next year. They're going to consult on trusts next year because they say the trust rules are complicated and they want to make them simplified and make them fairer and make them more transparent. Well, if that relates to simplifying inheritance tax and some trust aspects, then I think that's probably fair. Otherwise, I think we really understand the trust rules as they stand. The government have also said that they will make non-compliance offshore cases that they're investigating. They're going to consult on that in 2018 with a view to extending the limit for which they can go back and assess. At the moment, they could go back 4 years, 6, or even 20, but they're looking at starting with a minimum of 12 because they say it takes a long time to establish the facts. And I have some sympathy with that. It can be difficult trying to get information when actually you have no right to obtain information from a foreign jurisdiction on the face of it. But I do think that HMRC may need to sharpen their own pencil and be more timely in terms of responding to correspondence. The last bullet point there is they're exploring how to use digital platforms to encourage compliance. There is now the automatic exchange of tax information between different countries, which has been in for the last few years. And I suspect what they're talking about there is they have all this information that comes in digitally. What they want to do is to use that to encourage people to be compliant where they aren't at the moment, and effectively to change behaviour without them having to go to the effort of chasing people to make them compliant. Certificates of tax deposit. These are effectively cash that you deposit with HMRC and you get a certificate. So if you thought you might have a tax liability, perhaps because you've done a tax calculation based on a valuation that HMRC could challenge, and you've paid the tax that you think is due, but let's say HMRC could argue the case and argue that more was due, you can buy effectively a certificate of tax, or you could buy effectively a certificate of tax deposit to cover the additional liability. And they could be anything from £500 upwards in value. I think 500 was the minimum. What the Revenue are now saying is they're abolished, so they're not issuing any new ones with effect from today. Certificates that are in place will be honoured until the 23rd of November 2023. They'll then be repaid if taxpayers haven't asked for them to be repaid in the meantime. And if they can't find out who to pay them back to, then the taxpayer will forfeit them and the value will go to the Treasury. Okay, let's move on to indirect taxes now. First of all, have a look at duty. So fuel duty remains frozen for the 8th year in a row. There's been a lot in the press recently about new polluting diesel cars. Well, they're going up one excise duty bracket from April 18, and that could cost for some diesels an extra £15 to £500 in a year. And there's also been a lot in the press recently about the rise on cheap high-strength alcohol. And should there be an increased levy placed on it? Well, he's decided to do that, typically on the white ciders between 6.9 to 7.5%. There's going to be extra duty on them. Otherwise, duty remains frozen on alcohol. So my top tax tip for the day is, if you like drinking cider, drink something of 8% proof, not something in the 6.9 to 7.5% range. Duty on cigarettes and hand-rolling tobacco goes up by 2 and 3% above inflation, respectively. Okay, air passenger duty, that is remaining the same, as the rates have been frozen since 2012. The exception to that is premium economy or long legroom seats, business and first class, where it'll rise by £16, and though for those travelling by private jet it'll be £47. At that point yesterday, the Chancellor said, "Sorry, Lewis," in his speech, in reference to Lewis Hamilton, and that is indeed a picture of Lewis Hamilton's personal jet. Okay, the Chancellor also spent quite a long time yesterday talking about trying to reduce waste from single-use plastic, such as disposable coffee cups, toothpaste tubes, polystyrene boxes and the like. And that follows on from the success of introducing the 5p charge for a carrier bag, which has reduced the use of plastic bags by 80% in the last 2 years. How that will work, or whether it'll just mean that the price of a takeaway coffee will go up by the appropriate levy, I don't know. We'll have to wait and see. But I don't fancy trotting down to Tesco's with an empty toothpaste tube saying, "Please refill this." SDLT, there was good news for first-time home buyers where homes are under £300,000. So if somebody was going to buy a home today, they'd be quite happy. If they bought it yesterday, they might feel a bit sick. And there's a tapering relief for homes between 300,000 and 500,000. The VAT registration threshold remains at 85,000, and that's going to remain till at least March 2020. And there was quite a lot of talk about that, because we're the highest threshold in the EU, and the global average is apparently £15,000. But the Chancellor is committed to keeping it static until March 2020. And then he had a go at the Scottish National Party, the SNP, and said, "Look, I'm now going to allow Police Scotland and the Scottish Fire and Rescue Service to be able to reclaim input VAT, which will save them around about £40 million a year, according to him." The next couple of slides about VAT fraud. So this is online marketplaces such as eBay and Amazon, where you can buy things online. And it's reckoned that there are a number of businesses which should be registered for VAT, making sales online, where they're not registered for VAT and therefore avoiding output VAT and paying anything to HMRC in the UK. So what he's doing, he's going to make the online marketplace jointly and severally liable for the VAT. And indeed, he's looking at a split payment model, so that if you buy something for £100 plus VAT on Amazon, the £120 never goes to the trader. The trader only gets £100, and the £20 goes straight off to HMRC. There's going to be a consultation on that in 2018. The next one is about VAT in Northern Ireland and the Republic of Ireland, because the Northern Irish are saying, well, look, in the Republic, the rate of VAT is 9%, and we're subject to VAT at 20%, and that's adversely affecting our tourism. And there's apparently already been quite a lot of lobbying from the hotel industry to say, could we please have a lower rate of VAT? But of course, that wouldn't just only apply to Northern Ireland, it would also apply to the rest of the UK as well. So although it was billed as a Northern Ireland issue, actually it's a bit bigger than that. The second bullet point there is VAT fraud in the provision of labour. And typically what there are apparently is labour-only subcontractors who supply labour to other subcontractors. And this is all about missing VAT trader fraud. So the first trader sells or loans labour to a second trader, but never pays the output VAT over to HMRC. The second trader reclaims the input VAT that they have been charged, and then lends the labour on to the third trader, then disappears. The third trader reclaims the input VAT they've been charged by the second trader, charges them on to another trader, and then they promptly disappear. So it's all about reclaiming the input VAT and then disappearing. The view here is that actually what you should do is that the first trader charges output VAT. It's VAT neutral for all the other traders in between, and it's only the end user who can reclaim the VAT, assuming that they are able to. The final thing I think there on that slide, we just go back to VAT and vouchers. These are things like M&S vouchers. If you buy an M&S voucher as a gift for somebody, they could spend it on goods that are standard rated, or they could spend it on goods that are zero rated. So the government are trying to look at those to try and make sure that they collect the right amount of VAT. And that's clearly going to take a little while because they're not expecting it to be in until January 19. So finally, if we look at the winners and the losers in this budget, clear winners, first-time buyers, mathematicians, because there was quite a lot on mathematics. It's reckoned that there is more money needs to be spent on teaching maths. House builders are in for a good time or a better time. New technology companies, a clear winner. And it looked to me as though there was a lot of investment that is planned to go into technology companies. The environment looks as though it might benefit. The losers will be diesel car owners, owners of unoccupied property, where the government is saying it's not right that you can have property which is unoccupied, and councils may be able to double the amount of council tax that can be charged. Clearly, anybody undertaking tax avoidance. And lastly, diamond white drinkers will have to go and find something better to drink. Well, I think that brings us to the end of the seminar. So thank you all for attending. I wish you a very pleasant rest of the day and a safe journey home. Thank you.